The risk in the system is only going up, and the market is now confused whether they should take those risks seriously or they should always buy the dip. Last week was very interesting because it was the earnings week for the big Mag 7 AI stocks companies. Some of the stocks were beaten hard, like Google, Nvidia, Oracle, IBM. But then some of the stocks like Microsoft went up like crazy, 11 to 12% in a day, and since then it has been going up and touching the all-time high again. So what does it mean? It means the risks are very visible in the system and the market is paying attention to it. But we have multiple buyers. You have institutional buyers and you have retail buyers. The institutional buyers are looking at it and paying attention, realizing the risk is going up. Why? Because these Mag 7 companies, the mega corporations, the AI companies are spending like crazy. They are spending, their capex this year has almost gone double compared to last year, and their projections are even higher. So the markets are questioning that when this capex is going to return profit. I think that's the number one question everybody's asking. And then what we saw last week is Google, one of the most successful tech companies in the world, has produced negative cash flow for the first time in recent years, which means their capex has gone so crazier they don't have free cash flow anymore, which means these companies are issuing corporate debt to finance their AI capital infrastructure cost. So now the market is asking, okay, where this is going to end? Are they building capacity that may end up like 2000 when the internet era went from boom to bust? Because they built out so much capacity that they did not have businesses to use them? Or is it really a genuine demand? I think that's the question everybody's trying to answer. And the other risk is the Chinese companies are also producing similar AI models. They're comparable, they're cheap, and they have capacity to scale up very, very quickly without any guardrails and without any ethics. So there are so many risks in the market that the institutional buyers are paying attention and they're trying to pull back, which is why those mega stocks were punished last week. But then the retail buyers came in and bought the dip. So Meta, which was crushed last week, gone back to the same level. Google, crushed, gone back to the same level. So as an investor, what we should do? I think we should pay attention to all of these things because there are a few things that we should be paying serious attention to. Number one is this capital infrastructure cost. If it is continue to go up and the margins are getting squeezed, then it's a real problem. And the margins can get squeezed when the competition becomes stricter, which means if the Chinese models also come into the market and they are becoming a commodity, and the price pressure will actually reduce the margin, which will make these companies to pay their debt even harder. And number two, if the interest rate goes up, right now the interest rates are not really spiking, but we see the US Treasury yield for 2 years and 10 years are going up. And Federal Reserve very closely follow US 2-year Treasury yield. And if it continues to go up, then the Federal Reserve will be forced to increase the interest rate as well. And when the interest rate goes up, then this debt burden will become very expensive for corporations to finance their capital infrastructure cost. So as an investor, what we should do? Because if we go all into this AI race, we will be exposed to all the risk. And if this risk becomes real, which means if it ends up busting this AI bubble, we will be the one holding the bag. And if we stay on the sidelines, we're missing all that potential gain. By the way, Warren Buffett has been sitting on the pile of cash for the last year. And we all were thinking, what does Warren Buffett know that we don't know? A lot of those times, I actually pulled back my investment because I was thinking, if Warren Buffett is not deploying cash, why should I be rushing into it? But then he is now forced to go back into the market after losing all that potential gain. So we cannot do that either. So we have to find a balanced approach where we could stay in the market, but not to expose ourselves to this AI trade. So we could perhaps buy a major broad market index like SPY and DCA on regular basis. If it dips, you buy more so that you can average out your price gradually, and then diversify your investment into multiple asset classes. Some in stocks, some in commodities like gold, silver. Oil is trading like crazy. You can also benefit from it. But the gold is also rising again. It has broken out its downtrend and now spiking up. And I also saw a report which the Central Bank of China is also buying like crazy for the last 3 quarters. So there's a lot happening in the macro space, in the financial markets, but we as investors have to be very careful. We should not be going all in AI trade, because if it gets hit, it's going to hit very hard, and we should not be sitting on the sideline keeping our cash position. We could be losing a lot of potential gain. So deploy your cash, but be strategic. Some equities, some commodities, some gold, some silver, some fixed income assets, even though it doesn't return you a lot, but it is keeping your capital preserved. And then some Bitcoin as well, because Bitcoin is still kind of not going below 60,000, which means it is showing resilience against all these odds. And if the money printing starts at some point, Bitcoin will be the first one to go up. Anyway, you let me know what you think about that. Put your comments down below. If you like this content, give me a thumbs up, subscribe to the channel, and if you want to have a one-to-one call with me, there is a link in the description below where you can book a call with me and we can discuss your investment strategy, your risk appetite, your career ambitions. All of this I can offer in a 30-minute call just for you. Until next time, see you later.